Obviously, if you have a property that has a mortgage on it, it's actually not, the property assessment says it's worth $1 million, but you have a mortgage for $500. It's not worth $1 million. It's only worth $500 because you have a mortgage attached to it, right? And you have to consider, if you're the person that is going to get that asset in the separation, you have to consider, is the bank going to allow you to have that mortgage? So, which is your department. I'm not even going to delve into that.
Hello and welcome back to the Divorce Circle. I am your host, Sabina Bubber, and today we are interviewing Candace Nancke. Candace is a highly respected accountant, and she has spent her career helping clients, businesses, and families navigate the financial side of transitioning through divorce and separation. Candace brings a wealth of knowledge in taxation, financial planning, and wealth management, with a special ability to make complex numbers easy to understand. Candace is a partner at Loren, Nancke & Company, an award-winning team who know and have straightforward advice on practical strategies that are key to successful tax planning, business growth, and wealth management. In this episode, we are going to talk about the critical role accountants play while you're going through a separation. From understanding taxes to asset division to building a solid financial foundation going forward, Candace's clear, practical advice will give you the tools you need to navigate this process more effectively and with confidence. Thank you, Candace, for joining us.
Thank you for having me.
Let's talk about common financial mistakes that are made during divorce.
For sure.
What are the most common financial mistakes that you see during divorce that people make during the proceedings?
I would have to say the biggest is, and this is going to sound non-financial, but the biggest mistake is not getting the accountant involved at the right stage. There's been a number of times where I've had clients come to me after they've already signed the divorce agreement, and by then it's too late. It's done. There's nothing I can do for them anymore. So getting the right advice from the right person at the right stage. And, it's not going to be just the accountant. The accountant needs to work with the lawyer and work with the financial advisor, with the mortgage broker. Like, the whole team needs to be in communication.
So I see that a lot as well. When you're going through a separation and divorce, it's extremely important to consult all your advisors prior to doing anything. And unfortunately, the lawyer is not the one who knows the accounting practices, knows whether you're going to qualify for a mortgage or understand your financial assets. Everybody is an expert in different areas. What are some of the common related tax pitfalls that you see in divorce agreements, particularly when there's a business involved or variable income?
So with the business, it gets infinitely more complex if there's a business, especially if it's an incorporated business, and especially if the business is only run by one of the separating spouses, because now there's an asset that is in the name of one spouse. And yes, there's rules where you can split your assets without having any tax consequences, but you can't take money out of a corporation with no tax consequences. So in order to divide those types of assets, it gets very complex. It requires a little bit of thought and knowledge about the financial situation. And sometimes it makes more sense to not split that asset and take a different asset instead. Like, it's, instead of getting half of every single asset, you're getting half of the assets. And the one departing spouse might get the business, one departing spouse might get the principal residence, depending on how that shakes out. So being a little bit practical about what asset you're getting sometimes needs to be in consideration.
How can couples make sure that their agreement is fair in terms of taxation and like the taxation, the principle, the perspectives in terms of just as you said with the corporation, if you don't want to tax out of that, pay the tax of drawing money out of the corporation, how can the couples make sure that they're getting a fair split?
Well, obviously some advice is going to need to be, those assets need to be valued. So sometimes that's a little bit subjective, valuing what is a business worth. Who knows what a business is worth depending on what kind of business it is. Some are very easy. Retail, it's a little bit easier than a service type business. So there's another level of expertise that needs to get involved, the valuator. So And then the tax consequences of taking assets out of that company, or maybe you need to look at there's a tax procedure that can be done. They refer to it as a butterfly, and you can split the business into two, but it's expensive to do. So if you're looking at a business that has a few $100,000 into it, probably not worth it. Multi-millions. Now, the cost of doing the complex tax work becomes more realistic, if you will. So to make it fair, basically everything just needs to be valued and added up, and then the tax consequences or the costs associated with splitting that asset, if it's a corporate business, needs to be factored into what those values are worth.
So as you were describing it, you said that it was more complicated if you've got one person owning the corporation and the other person not. I would think it would be the opposite when you've got two people that are working in a corporation. Now they're running a business together and divorcing, and they're both taking income from the corporation, and that's been their livelihood, but now they can't work together or be married. Is that not far more complicated?
It's complicated in a different way. That would be complicated in a not in a tax way, but in a relationship way, obviously. But if you have two people that own and run the business together, it's easier from a tax perspective to split that business than it is if one is not involved.
Okay. And what if you've got one person they're both on the corporation, so that for tax planning purposes, so they can draw dividends for income, maybe reduce their taxes, that kind of thing. And now one person who doesn't run the business but is still an owner, now they're no longer going to receive income from that business. Can they receive income from that business if they're getting divorced?
Well, possibly they couldn't have. Well, they could before, but they're going to be at there's special rules where if you're not involved in the business, you're taxed at the top rate.
Oh, okay.
Yeah. So a lot of planning avoids that these days. Not necessarily. It depends on what the income levels are. But so if you just have somebody on the shares and they're not actually active in the business, then you're looking at a situation where you're trying to separate a business with a non-active person and the active person. So the scenario is going to be slightly different, but not fundamentally different if they didn't have shares at all.
Got it.
There's a lot of details in there. Obviously, I'm simplifying this.
Yes, of course, because we don't have all day.
Yeah, no, we don't have all day. But at a very high level, yes, it's
okay.
Yeah.
Okay.
Yeah.
So what are some considerations regarding mortgages, property, and coming to a resolution on that? Is there any implications tax-wise on that?
Not on the mortgage per se, but obviously if you have a property that has a mortgage on it, it's actually not, the property assessment says it's worth $1 million, but you have a mortgage for $500. It's not worth $1 million. It's only worth $500 because you have a mortgage attached to it, right? And you have to consider, if you're the person that is going to get that asset in the separation, you have to consider, is the bank going to allow you to have that mortgage? So, which is your department. I'm not even going to delve into that. That's why I call you when that happens. But from a tax perspective, it's not really an issue. Tax only looks at what is the asset. Is the asset taxable or not?
Yeah.
So principal residence not going to be taxable. Rental property is going to be taxable. So obviously you have to factor in the fact that there's going to be tax payable on the capital gain. So in a hard dollars sense, that asset is worth less than what the principal
understood
the property assessment says it's worth. Yeah.
Right. How can business owners safeguard their businesses from the financial impact of the divorce?
It's difficult. Like unless you've, that business has been sheltered in some way with a prenuptial agreement, which is lawyer's department, or it's been an inherited business and you've been careful to keep it as a segregated asset. The assets of the marriage are the assets of the marriage. And so you're going to have to figure out how to divvy up those assets, including that business.
That's complicated.
It's complicated. Yeah, for sure.
Now, what about support, child support, spousal support? So what is taxable? Who pays the taxes on that? Let's start with child support.
So child support used to be a long time ago that it could be taxable to the recipient, but that has been taken away. So these days it's a lot easier. Whoever receives the child support, as long as it's paid as a periodic payment in accordance with an agreement, it's not taxable to the recipient and it's not deductible to the payer.
And then spousal support, how is that? How is the impact on that?
Yeah, so spousal support is the opposite. As long as it's a periodic payment and it's subject to an agreement, the person receiving the spousal support pays tax on that, and the person paying the spousal support gets to deduct it. Now, one of the mistakes that I see is in an effort to be absolutely fair, because the person who's going to end up paying the spousal support has a higher income, but it's not stable. So it goes up and down, or it's on a trajectory where it's going higher. So I've seen situations where, this incredibly fair and complex formula is sorted out so that the spouse that's going to be receiving the support gets some sort of variable percentage of this income. I have to tell you, the one poor client that I had this type of agreement, and one of my business partners had the same situation. The deduction on the payer's return was audited every single year. Because what happens in CRE's system is the first year that it's filed, they review it almost 100%. They ask for all the documents and they register the amount of the support in their system. So next year when it's higher, they just deny it and audit it because it's not what they've put in their system. They don't have a system that will account for a variable spousal support. So while it's fair because you want to project what that income is going to be, I understand why it was done, not terribly practical and very unfair for the person that was paying the support.
So they would get audited every single year?
Every single year.
Oh my gosh, that's terrible.
Yeah. So I think...
And expensive.
The only year that he wasn't reviewed was the year that his income, for whatever reason, took a dip. Mm-hmm. So it was less than the previous year, so they didn't review it.
So obviously another reason why you should talk to your accountant before you sign your agreement. So maybe your accountant would advise you of that, and perhaps you and your lawyer can come up with a solution that would not require additional costs around being audited by CRA every year.
And it's not inconsequential either, because when the spousal support is being reviewed, they want to see the void checks.
Yeah.
They want to see the agreement. They want the spouse that received the payments to sign receipts or an acknowledgement that they received it. Like it's asinine, actually, the amount of documentation that they wanted to receive. So.
And now from a spousal support standpoint, as a mortgage broker, I always, if I'm talking to my client prior to them negotiating the separation agreement and they're the one that's going to be paying spousal support, I often recommend that they try to do a spousal buyout, because those monthly payments for spousal support can be significant. And that can keep them from qualifying for a mortgage. So their ex-partner is receiving child support and spousal support, and they can get a mortgage, but the person who's earning the money can't get the mortgage because of the size of those payments. So I say, make a settlement, whatever that sum's going to be. If it's a period of 5 to 10 years that you're paying that spousal support, pay it as a lump sum so that you can still qualify for your housing.
Yeah.
If somebody does a spousal buyout and pays a lump sum, is that going to be, what are the tax benefits for them, or are there any tax benefits?
There isn't. So in the situation of a lump sum payment, CRA does not allow the deduction, and nor does the person that receives it have to pay tax on it.
Okay.
So it's considered part of the separation of assets.
Okay. All right. So then there's no benefit. So likely the lawyer would recommend that they should take the monthly payment because they'll get the tax benefit, but then they'll walk into their bank or their mortgage broker and not be able to get their financing.
Yeah. So there's a lot of subjective details that need to be considered in the context of saving tax is not the only objective.
No, housing is usually where
Yeah.
am I going to live is one of the first questions people ask after when they're getting divorced.
So the other thing I wanted to mention on child support payments, sometimes what I'll see is that there's child support payments that go both ways.
Mm-hmm.
And the lawyers love to offset these against each other, and you cannot. The payments actually have to be made. So the one spouse that pays, like usually they're differing amounts. So one spouse pays the child support to, spouse A pays spouse B, and then spouse B pays spouse A, and the inclination is just to pay the difference. But what happens then is that CRA can potentially disallow because there's not a payment been made both ways. So it's you got to be careful about that.
Let's dig into that a little more because that was kind of a gloss over, and I know that's a really important thing to state.
Yeah,
and I think it's a really important thing for this podcast is to understand that if both are earning money, that both should be making child support to each other. So if one is earning less, say for example, there's child support tables that you can look up online for the calculations. So one person's earning $50,000 a year, one person's earning $100,000 a year. There's two children. It's the province of BC. You plug that into the calculator and it says, okay, $50,000, you're paying $1,000 a month of support. At $100,000, you're paying $1,500 of support. So the person that's supposed to pay $1,000 should write a check to the other person for $1,000.
Yeah.
The other person writes a check for $1,500.
Yeah.
And so the person who is getting the $500 is getting the net benefit of those two checks. But CRA wants to see those two checks going back and forth. Is that correct?
Yeah, that's correct.
Okay. And that's extremely important.
It's extremely important.
Okay.
I have had it denied because there's a very limited set of circumstances where I think you can offset them, but it's so convoluted. It's just do the checks.
So what is the impact of, and what about, okay, let's talk about checks versus transfers. Will CRA accept Interact transfers instead of checks?
Transfers are not a problem. I do recommend keeping, the notation of the transfer information. And in that scenario where there's a CRA review, we do end up having to get receipts signed by the recipient.
Okay.
Yeah.
And so going back to getting the accountant involved early, is that something when you know that there's child support going on that you let your clients know right away?
Absolutely.
Yeah. Okay. Yeah. And then what are other things that, being involved early in the process, if somebody calls you and says, Candace, I'm me and my partner, we've decided to separate. What are some of the things that you will immediately cover off right off the bat for them in terms of things they need to know when they go talk to their lawyer?
So usually I have a pretty good idea of what their assets are and I know where the problems are going to be. So, we have a quick discussion about, because usually by then they've had discussion with the spouse that they're separating from or not. Sometimes not, but sometimes I'm the first call and the spouse doesn't know yet. We have a discussion about the tax implications of splitting the assets and what, would be beneficial and what the preliminary thoughts are. And then my second thing is make sure that the lawyer and I are connected so that we can have conversations. Because frankly, the conversation between me and the lawyer is very fast and furious and full of like acronyms and all sorts of things. But it's a bit of a shortcut because they know what I'm thinking, I know what they're thinking, and then we can both properly advise the client based on what they're thinking. Right.
And then the agreement can be structured properly to benefit your client better. Yeah. So that is money well spent on your client's part to take the time to do that, to make sure that it's structured properly. Yeah. I've seen so many people try to save money on accountants, lawyers, and they, ChatGPT, let's do our own agreement. Yeah. And then it ends up being a bit of a gong show on the back end once they actually have signed it and things are not as, oh, well, my ex-husband said that this was legal and enforceable. And it's like, yes, it is. However, it has nothing to do about legal and enforceability. For your mortgage, it's going to be a problem the way you wrote it. For your taxes, it's going to be a challenge for the way you wrote it, and you're going to have tax implications. So always good to use professionals.
Yeah. The tax implications honestly are the least of it's the what those tax implications mean for the other things. Like and it's an all interlaced.
Yeah.
So, and I find that people feel that it's going to be more expensive if the professionals are talking to each other, and I actually think it's a shortcut in a way.
Yeah. And so what are the most common pitfalls you see in terms of tax implications after separation when people haven't really taken that time to use their professionals up front?
The surprise about the lump sum, they get very excited. The person receiving the lump sum gets very excited about receiving the extra lump sum, and then they realize that the person paying realizes they don't get a tax deduction for it. That's always disappointing for them. So one spouse taking the principal residence and one spouse taking a rental property, and then the person receiving the rental property doesn't realize that there's going to be a tax cost eventually to the net value of it. So really the person that got assuming that they're equal value, the person that got the principal residence actually got the more valuable asset because
there's
of
no long-term implications.
Yeah. And I'm not going to say it's purposeful, but having the right advice obviously would solve that.
Yes, of course. So going back to spousal support, so the person that's paying the spousal support is not paying the taxes on that, but they're not reconciling that until they file their tax return. Is that right? So say you're paying out, I'm just going to throw a number out there. Say you're paying $5,000 a month in spousal support, but you're not getting that tax benefit until you file your taxes. That's really affecting your cash flow. Is there a way to talk to CRA to be able to correct it on a monthly basis or in advance where you're not paying tax on that money? You're not using your after-tax income to pay that $5,000 and then just waiting for the refund in 12 months, because that can really affect you on a cash flow basis, can it not?
So I'm assuming we're talking about somebody that's actually working for an employer.
Yes.
In that situation, yes. There's a form that can be filled out that reduces your tax at the source. It has to be, approved by CRA, and then the employer can reduce the amount of tax that they take off your paycheck to account for that amount.
And then does that have to get approved every year, or does that just get approved ongoing?
I don't actually know. Probably. Yeah.
Okay. Well, that's not very much fun. And can you do that if you're self-employed?
Well, if you're self-employed, you have control over the amount of tax that you pay.
Oh, I see.
Right?
You don't need permission from CRA in terms of...
No, the only repercussion is if you owe taxes and you don't make enough installments, you get charged with interest. And if you haven't paid enough, you get charged with installment penalties. So it's a little bit more flexible in that way.
Okay.
Yeah.
And how do you, let's talk about, since we're talking about self-employed, let's talk about business evaluations. Do you as an accountant get involved in business evaluations, or how do you value businesses? How do you do evaluation on family businesses?
So I generally don't do the valuations for this purpose. I do valuations for the purposes of internal reorganizations. So we're determining what a value is for the purposes of restructuring a business for the people that already own the business.
Okay.
So so there's nobody outside the circle, so to speak, that's being affected by that reorganization. We're doing our best to make sure it's a reasonable value. But in a situation where the value is affecting two opposing factions, let's say, I do recommend that they use an actual person that is actually trained in the art of valuing businesses, because it is an art. There's science to it and math, obviously, but there's an art to it as well, because how do you value a family business that is in the, that's providing, a service? How do you value that? Is it very dependent on the head of the family? Like if that person was taken out of the business, does it survive tomorrow? There's a lot of subjective factors, and they just have more experience. They've seen more businesses, so they have the skills and the history and other valuations to draw on to be able to make a fair assessment.
And are those people generally accountants that are doing those valuations?
Sometimes, yeah.
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 And then what about forensic accounting? So I hear this term a lot when it comes to evaluating cash flows or, oh, my ex is hiding money or knew that we were getting divorced and all of a sudden the income has dropped, but I think it's hidden somewhere or they're funneling it somewhere. Do you get involved in that, or what is in, maybe not ask about you, but what is forensic accounting and how is that used in a divorce and when is it necessary?
Yeah. So that again is a specialized area of accounting. It's not something that we specialize in. So the purpose obviously is to trace where the money is and where the money is gone, using specialized skills, past experience, knowledge of what people tried to do, to source out where the funds are. It's a bit of sleuthing, obviously, that would be involved in it. So there are accountants that specialize in that, figuring out where the assets have gone, where the money has gone, where they currently are, that type of thing.
If there's any hidden chest of gold at the end of the rainbow.
Yeah, not overly practical in a divorce where you're trying to separate hundreds of thousands, but obviously very relevant if you figure somebody's hiding millions of dollars.
Oh, I see. Okay.
Yeah. Because the cost, do you know what I mean?
Yeah, of course.
Yeah.
Because the cost of forensic accounting can be significant.
Yeah.
Got it.
Yeah.
And now,
so practicality. You need to apply some practical.
Financial practicality.
Yeah. Yeah.
So once the dust settles on a divorce, how do you help people to navigate their new normal in terms of how they're filing their taxes, the implications of the divorce on their taxation, that kind of thing?
So we have a lot of experience with this actually, and it's very similar for recently widowed spouses where they have not been the person that have been taking care of the finances. If the person is taking care of the finances, they're usually fine. Obviously we have some adjustments to make, but everything seems to be fine. But in the situation where we're taking care of the spouse that was not the person taking care of the finances, there's a little bit of education that goes on in there. And we try and do that in a very respectful way. They're not stupid or anything like that. It's just not something they've been involved in. And it can be very intimidating to try and talk to an accountant. So our team tries to be very helpful in that regard and try and keep it in a very plain English way so that they feel comfortable asking questions. Because honestly, it's when they ask the questions that we know exactly we can't think of everything. But when they start asking, when they're comfortable to ask us questions, we can help them the most.
What steps should somebody take as soon as they're divorced? Like, do they need to call you right away or just wait till tax season? Is there...
It depends on what kind of assets we're talking about. Like if both of them were employed and they have RSPs, it's probably going to be pretty vanilla.
Yeah.
About what's going on. But if there's a business or now they have a rental property that they never had before and things like that, there's probably some things that they need to keep track of that we're going to need at tax time. So it doesn't hurt to check in. Right?
Okay.
Is there anything I need to know?
What about RESPs? So most parents will own those RESPs jointly. What is the impact of that? Do they need to have, do you need to change the structure? How does that work? Is there any implications on the tax side for that?
Well, unless there's a situation where the spouse is not involved with the children anymore or something like that, I don't see why you would have to change that. I would probably defer that question to a financial advisor. Maybe setting up different ones for future investments, depending on the situation. But
right. And if it's not a volatile situation, both ex-partners can still contribute to that RESP just because they're not married. It's okay that they still have that asset as a joint asset. Is that right?
Yeah, because they're still parents of the children, right?
Right. Okay.
Yeah.
So what's the difference between what a family lawyer handles in the divorce is from a tax perspective and what the accountant handles? So often, like you say, your clients will come after they've signed the agreement. So are the lawyers giving tax advice to their clients, or are they just assuming that the clients know what's happening? Like what would be the difference?
It's hard to say. I don't think there's a black and white answer for that. But I mean, there's a lot of lawyers that do know a lot.
Mm-hmm.
But unless they take the history of the client and they factor in all the numbers, there's chances there's going to be things that are missed, right?
Okay.
Yeah. I think it's maybe expediency, You can get lured into a false sense of security if the client seems confident and this is the way that they want things to go.
Yeah.
And the client hasn't taken the step to talk to an accountant. It's not up to the lawyer to get the accountant involved. It's in the client's best interest to have the conversation. Yeah. What they can, yeah.
Do you have any examples of a time when a client not getting the accountant involved in advance had massive implications for them after the divorce?
Well, the variable spousal support was definitely one. And then I did have a client where one spouse took the home and one spouse took the rental, and there was no consideration given for the fact that there was going to be taxes paid.
Okay, so it's again, can't emphasize enough. Doesn't matter how vanilla your taxes are, always consult your tax accountant about that.
It might be a 5-minute phone call. Hey, we're thinking about getting a divorce. This is what we got. Do I need... And if the answer is no, great. Things are going to be simple.
Yeah.
Right?
Or it might be, let's have a Zoom call. Let's have a discussion. Yeah. Quick rundown of what's happening and maybe some advice handed out. And that can be provided to both, correct?
Absolutely.
It doesn't have to just be given to one?
Yeah.
Okay.
Generally speaking, we try not to represent both halves of a separation, especially if there are complex assets where, subjective advice is going to have to be given, because there is a certain level of distrust that occurs. One spouse just doesn't trust that, they're getting fair advice, and fair enough. It doesn't matter whether it's true or perceived. There should be a second advisor involved.
Okay. And then there's also the risk of information if it's contentious information being shared inadvertently?
If it's contentious, I would refuse absolutely to represent both sides. Yeah.
Okay. And then for our audience, what's one piece of advice you would give to anybody going through a divorce that would benefit them?
Know who your professionals are and talk to them sooner rather than later. That's the key advice right there. Make sure that they're all in connection with each other.
Yeah. And I say, because I see this a lot, is if you're working with a tax accountant or an accountant, is know what their certifications are, know what their qualifications are.
Yeah.
What's the difference between a bookkeeper who's giving tax advice and a tax accountant who really understands the ins and outs of working with CRA? So sometimes people are trying to save money working with an accountant, so they tend to work maybe on the lower scale, and sometimes you'll get what you pay for, and that might cost you money in the end.
Yeah, for sure. Yeah. Look for somebody that has some experience in it, and definitely look for somebody with the CPA behind their name. In this province, legislation says that you're only allowed to hang out a shingle saying you're a professional accountant if you have CPA letters.
And the CPA stands for?
Chartered Professional Accountant.
Okay, thank you. And now, rapid fire questions.
Oh, okay.
Coffee or tea?
Both, actually. I am coffee in the morning and tea in the afternoon.
Oh, really?
Yes.
Morning person or night owl?
Probably morning. I'm asleep by 9.
Are you? What's the book you're currently reading?
I'm actually reading for work right now because we're doing a bunch of things. So I'm reading The 4 Obsessions of an executive by Lencioni.
Oh,
So,
okay.
Yeah.
And what's your favorite guilty pleasure TV show?
Oh, right now, probably Landman.
Is that the one with
Billy Bob Thornton?
Oh, yes.
I love Billy Bob Thornton.
I've seen it. It's great.
Yeah.
What's your go-to comfort food after a long day?
Probably a scone with the tea.
Oh, really?
Yeah, I like
nice.
I like cranberry lemon scones.
Do you bake them yourself?
Sometimes. Yeah.
Oh, nice.
Yeah.
What's one song that instantly lifts your mood?
Lovely Day.
When you have a free weekend, what do you like to do?
Outside. So sometimes quadding, sometimes hiking with the dogs, but definitely outside.
So you like to work virtually?
Yes.
Yes. So you live close to nature.
Absolutely. Nature's in my backyard. Yeah. Actually, we bought property that has its own forest. Our dogs have their own forest.
Oh, really? So you just let them out and they run? Yeah. Oh, I love that.
Yeah.
And what's a hidden talent people don't know about you?
So not very many people know that to put myself through college, I used to drive truck.
Really?
Yes.
Well, that's fantastic.
Yeah.
So you have your class 3
Class 3
license?
Yeah.
Cool. Wine, cocktail, or mocktail?
It differs depending on where I am, but probably most often red wine.
Red wine. Okay,
Yeah.
great. Candace, thank you so much for joining us today. I actually learned a few things during this conversation, and I think that it definitely will add value for our audience looking at getting a divorce and needing to know that they need to talk to their accountant. So thank you very much.
I was really glad to be here. I'm glad that I could share my knowledge, and I hope I help somebody too.
Thank you. Thank you for joining me today on the Divorce Circle podcast. And don't forget to subscribe so you never miss an episode.